If you're looking to buy a new phone or shoes, you'll have an idea of a fair price that you'll pay for them. As a new investor, getting to know the fair price you'll pay for stocks can be difficult. Today, I'm going to be covering one of the most commonly used metrics by investors to screen stocks for value, the PE ratio. Let's meet Sam. Sam has got some money that he would like to invest. Sam loves ice cream, and he plans on purchasing an ice cream shop. As he walks down the street, he finds not one, but two ice cream shops on sale. Shop A is on sale for $10,000 and has made $5,000 profit or earnings in 1 year. Shop B is on sale for $13,000 and has made $7,000 profit or earnings in 1 year. Which of these ice cream shops should Sam buy? Luckily for Sam, he has got a trick up on his sleeve. He's going to use a metric system called the PE ratio to find out which shop is at a greater value. PE ratio, otherwise known as price to earnings ratio, is worked out by dividing the price, in this case the price will be shop's price, by the earnings, which is a yearly profit the shop has made. So let's look at shop A first. PE ratio will be the shop price, which is $10,000, divided by the yearly profit, which is $5,000. So for shop A, the PE ratio works out to be 2. Let's now look at shop B. PE ratio will be the shop price, which is $13,000, divided by the yearly profit, which is $7,000. So for shop B, the PE ratio works out to be 1.86. So what does it mean to have a PE ratio of 2 for shop A? It means that if the shop continues to get the same result, Sam would get his money back in 2 years' time. So in 2 years, Sam would have earned $10,000 and he would own an ice cream shop A. PE ratio of 1.86 for shop B would mean that Sam would get his money back in 1.86 years. So, if these shops continue to perform the way they did and they are similar, Sam should purchase shop B, which would make his money back faster. When it comes to PE ratio, the lower the PE ratio, the better the value. Public companies work in similar ways, except they're broken down to what we call shares. So let's go back to the ice cream shop example. Let's say shop A has issued 100 shares. This means that ice cream shop A is divided into 100 equal parts in terms of ownership. Each share of ice cream shop A will be worth $10,000 divided by 100, which equals to $100. So if you were to purchase one share of shop A, this would cost you $100. Now, if the ownership is broken down to 100 equal parts as shares, so are the profit. What each share has earned is known as earnings per share. This is worked out by dividing the profit, $5,000, by the number of shares, 100, equating to $50. So one share of ice cream shop A, which costs $100, has earned $50 in 1 year. In public companies, the PE ratio is worked out to be share price divided by earnings per share, or the EPS. So, to work out the PE ratio, we would divide $100 the share price by $50 the EPS, or earnings per share, which equals to 2, which is the same figure we got earlier. Let's work things out for shop B as well. If shop B has issued 50 shares, to work out the price of each share of ice cream shop B, we will divide the price of shop B by the number of shares issued. Each share of ice cream shop B will be worth $260. The earnings per share for shop B will be profit divided by the number of shares issued, and this works out to be $140. So, one share of shop B would cost $260 and has earned $140 in 1 year. PE ratio of shop B is worked out by dividing the share price of $260 by earnings per share $140, which equals to 1.86. Now let's suppose that Sam gets a hold of the news that ice cream shop A is planning to sell different ice cream products next year. The new ice cream products will be more delicious and customers will pay higher price for them. Meanwhile, shop B is planning to sell the same ice cream next year, and Sam reckons customers are getting tired of the same flavor. As a result, Sam reckons that the profit of Shop A would increase their profit by whopping 50% next year, while Ice Cream Shop B would see a decrease in their profit by 10%. Now this news would have affected the valuation of two ice cream shops. But how do you calculate the value now? Again, lucky for Sam, he has got another trick up in his sleeve. He is going to use the forward PE ratio. What we have seen until now is termed as the trailing PE ratio, and this looks at the past performance. The forward PE ratio looks at the future performance and tries to work out the value of a company. So when working out trailing PE ratio, you would use the last yearly earnings, but the forward PE ratio would use the next year's projected earnings. So let's assume Sam is correct and work out what this means for Shop A. Shop A's earnings per share, or EPS, will be $75 next year. That means Shop A share would earn $75 next year. Shop B's share would earn less next year, with their earnings per share, or EPS, being $126. So if Sam believed that Shop A would perform in the future as well as the past, the trailing PE ratio would be the right way to value Shop A, which is worked out to be 2. However, as Sam is confident with his prediction, he believes that Shop A should be valued with the forward PE ratio, which is worked out to be 1.34, and that is at a much higher valuation. This is similar for Shop B. If Sam believed that Shop B would perform similarly in the future as in the past, trailing PE ratio, which works out to be 1.86, is a measure he would use. But again, as Sam predicts that Shop B would do worse in the future, he would use the forward PE ratio, which works out to be 2.06, and that is at a much worse valuation. If Sam is correct, Shop B, which looked to be of better value, is no longer at great value because its forward PE ratio is significantly higher than that of Ice Cream Shop A. So, to summarize, Sam was smart in not just looking at the share price or the shop's price to determine the value of an ice cream shop. Price does not represent value. In fact, share price does not even represent the price of a company because it's highly dependent on the number of shares issued. Trailing PE ratio is a useful tool to figure out which company is valued better, if the companies are similar and is likely to perform in the same way in the future as in the past, just like Shop A and Shop B continuing to sell the same ice cream. Forward PE ratio is a much more useful tool to use if the future performance of the company is to be different to that of the past, just like how Shop A is upgrading its ice cream products and Shop B isn't. In this video, we looked at how to use PE ratio for valuing companies, trailing PE ratio, which looked at past performance, and forward PE ratio, which looked at future performance. It is important to note that PE ratio is used mostly as a screening tool for valuing companies rather than used for detailed company valuation. If this video was helpful, please push the like button, and for more content in stock investing, subscribe to the channel Invest with Park.